Hey, 2025 could be your best year to start building wealth through real estate. Multifamily investing in Montreal is not just a trend, it's one of the smartest moves you can make. In this guide, I'll show you exactly why multifamily properties are the key to unlocking passive income and long-term financial freedom. I'm LJ Aguinaga with LJ Realties, and as someone who owns more than 75 multifamily units and manages over 200 doors through my property management company Plex Doctor, I bring first-hand experience and insights to the table. Today, we're diving into everything you need to know about investing in multifamily properties in 2025, from understanding market trends to finding the best deals and overcoming common challenges. This video will equip you with all the tools you need to succeed in Montreal's dynamic real estate market. Let's start with why multifamily investing makes sense in 2025. Well, multifamily properties present an exceptional opportunity for consistent rental income and property appreciation. In 2025, rising housing demand and inflation make these investments even more attractive than before. Montreal's rental market, characterized by low vacancy rates and high demand, is a prime environment for multifamily investments. Whether you're leveraging house hacking, which is living in one unit while renting out the others, or focusing entirely on generating passive income, these properties can offer impressive returns. For example, investors in neighborhoods like the Plateau Montreal have seen significant equity growth due to the area's consistent demand and development. Multifamily investing is not just a trend, it's a strategic pathway to building long-term wealth. Where's the best place to find multifamily deals in Montreal? Well, we can start off with high-demand neighborhoods. We typically like to knock the youth for their preference in lodging, food, work, etc. However, when it comes to real estate, I love investing where the younger generation is moving. In Montreal, this has been the Sud-Ouest, Verdun, Hochelaga, and beyond. Young adults tend to look for places that are a bit more affordable and make the area cool. They start opening coffee shops, restaurants, and other convenience stores to improve the neighborhood. Next, the infrastructure impact. This is the next great path to follow. As the old adage goes, follow the money. Look where the city or provincial governments are investing money and resources. These areas will typically attract a fresh demographic of residents and may even offer subsidies for investment. Next up, public transportation. My general rule of thumb is to focus on areas that are within a 30-minute commute of the city center. We have harsh winters in Montreal. This means that people want to limit their time outdoors when it's minus 20 degrees outside. I generally favor properties that are within a 10-minute walk of a metro station. However, 15 minutes is the absolute maximum that I will personally consider for my investments. Pro tip, partner with a knowledgeable real estate broker that can help you identify the best hidden gems or best investment opportunities in the current market. How to finance multifamily investments, you might ask? Financing multifamily investments can seem tricky at first. People ask, should I go with a commercial loan or a traditional residential mortgage? There are key differences to the financing options. Let's start off by discussing when you can use each. Residential financing uses your annual income and determines whether or not you can service the debt. The bank will use market comparables to determine the evaluation and lend based on that. Some institutions will allow you to use residential financing for up to an 8-plex, that's 8 units. This is a great option for high-income earners or when you're getting started. You will usually access a higher loan amount by using residential mortgage. There is a catch though. Most institutions will cap the amount of residential mortgages you can have, typically around a maximum of 5. Now, commercial financing. This focuses on the property and not the borrower. The bank determines whether the property can service the debt it will be taking, not the borrower. The bank will use the economic value of the building when determining loan amounts. This is calculated by dividing the net revenue by the cap rate of the neighborhood. The advantage of commercial financing is that you are not limited to the amount of commercial loans that you can take out. This means that you can have exponentially more buildings and continue to grow. It also means that your income doesn't play a role in the qualification, which is fantastic as you continue to scale up. Tips for qualifying. Keep an updated personal balance sheet. This includes a breakdown of all your income-generating revenues and expenses. Build a strong credit profile, have a clear investment plan, and work with a mortgage broker experienced in multifamily financing. A good mortgage broker who is up to date with all the latest programs is an invaluable resource. There's been a lot of changes over the last couple of months, and it's really important to work with somebody who understands them and can get you the best program and the best financing through these programs. How to analyze a multifamily property. When thinking about how to analyze a multifamily property, you should look at a few key metrics or formulas. First, cash flow. You calculate this by taking the rental income against expenses like mortgage, taxes, insurance, and maintenance. Don't forget to include a reserve for capital expenditures like the roof, exterior siding, balconies, etc. Next, we have cap rates. Use this formula to assess how the investment compares to the market. You're going to use net operating income and divide that by the purchase price. Understand what the going cap rate for investments in a particular area is. This will help you assess your investment versus the neighborhood. Third up, we have vacancy rates. Research local market data to understand how likely it is to keep your units occupied. Take advantage of units that are currently vacant to negotiate a better deal or to allow you to do some renovations and optimize before renting it out. Take these two properties for example. They both have 6 units, but one has an interior staircase, basement storage, and outdoor parking. While all of these features may sound like positives, they represent additional expenses. You need to pay for the electrical service meter for the lighting and the heating. You'll also have to pay for the snow removal in the winter. The reality is, most tenants won't pay enough of a premium to cover these costs. Next up, we have some common challenges in multifamily investing. The first one is tenant management. Managing multiple tenants can be time-consuming. Proper screening and setting clear expectations are key to avoiding issues. Shameless plug, if you truly want this to be a passive investment, let my property management company, Plex Doctor, handle the management for you. We manage each unit as if it was one of my own. Property maintenance. Multifamily properties come with higher upkeep costs. Budget for regular repairs and unexpected expenses. The devil is in the details. Don't overlook these. It is critical. Next up, market competition. The demand for multifamily properties is growing, so be prepared to act quickly and strategically when bidding on properties. By studying your market properly, you'll be ready to jump on the right opportunity as soon as you see it. One of my favorites, we have tax benefits and the incentives for multifamily properties. First off, we have deductions, obviously. Landlords can deduct expenses like mortgage interest, property management fees, and maintenance costs from their taxable income. Make sure to keep a detailed record of all expenses so that you can provide them to your accountant come tax time. This is critical. Please don't forget to do this. Now let's look at some of the Quebec-specific incentives. Look into provincial tax credits and grants available for multifamily investors, particularly for energy-efficient upgrades or affordable housing. Tip: consult a tax professional to maximize your benefits and ensure compliance. Number 7, strategies for managing multifamily properties. The first option is obviously self-management versus property managers. Decide whether you want to handle tenant issues yourself or hire a property manager to save time and reduce stress. I recommend you manage your first property on your own for the first year. This will allow you to get familiar with owning and managing a property. Once you understand how it works, feel free to outsource the job in order to allow yourself to focus on growing your portfolio. Tenant retention. Keeping tenants happy by addressing issues promptly, maintaining clean and safe properties, and fostering good communication is critical in a successful property. Keeping tenants in your property is an easy way to reduce your expenses. You won't have to pay rental commissions and stuff of that nature. Generally, losing a tenant will come with some maintenance costs and possibly rental commissions like I mentioned before. Minimizing turnover. Long-term tenants mean lower costs and steady income. They also tend to take care of the property as if it was their own. Build positive relationships and offer competitive rents to encourage tenants to stay. Here's a real-life success story. A client of mine has been able to buy 2 duplexes over the last 3 years. He bought both of them for $430,000. He ended up investing roughly $80,000 into each of them as improvements. His all-in costs for both came out to about $510,000. Once renovated and rented, he went to the bank to refinance. The bank evaluated them at $600,000 and was happy to give him a new loan of $480,000. That's 80% loan to value. This means he now owns both properties with only $30,000 left invested in each of them. His monthly revenue is $3,300 per building, and his costs are $2,930. This means he cash flows $4,440 per building annually for a total of $8,880. That's a 14.8% cash-on-cash return. When you add the appreciation and the capital paydown, his return on investment is absolutely amazing. On top of this, he could sell them both and pull out over $200,000 in profits after commissions and expenses. Real estate is not sexy, and it won't make you rich overnight. But even with a duplex, you can start to build solid equity quickly in our market. Investing in multifamily properties in Montreal is one of the smartest ways to build wealth in 2025. With the right strategy, financing, and property management approach, you can achieve consistent cash flow and long-term appreciation. If you're ready to start your multifamily investing journey, reach out to me and my team at LJ Realties. Don't forget to like this video, subscribe to the channel, and share your thoughts or questions in the comments down below. Let's make 2025 your most profitable year yet. Thank you for watching. I'll see you at the next one.